Good morning, good afternoon, and good evening, and welcome everyone to this session on illicit financial flows. My name is Michael Stemmer, and I'm an economist in the Tax Policy and Statistics Division of the OECD Center for Tax Policy and Administration. First of all, I would like to thank everyone who is participating today, and we are glad that this important topic of illicit financial flows attracts such a wide audience. We would also like to thank our donors who actually made this workshop today and yesterday, and also our work more general on this topic possible. With regard to questions, please put them into the chat box in the software, which is underneath of the presentation, and we will address them at the end of the presentation. Today we would like to introduce our work on tax compliance and illicit financial flows in South Africa, focusing particularly on tax data that will enable us to measure and to assess tax-related illicit financial flows. To provide you with a quick overview of what we will cover within the next 30 to 45 minutes. We will, first of all, present you with an overview of why IFFs are harmful as they are, particularly to developing countries, their inherent difficulty of defining them, but also the challenges with regard to measuring them. So this definitely relates to the question how to measure something that is inherently not supposed to be measured and supposed to be reported. We'll provide an overview of global estimates and why we think that there are severe measurement challenges attached to them. We will have a look at exchange of information, which provides us a new perspective on tax-related IFFs. And in the end, we look at a joint project that is currently conducted between the OECD and South Africa's National Treasury with regard to new insights on tax-related IFFs and taxpayer compliance in South Africa. Next slide, please. Thank you. Well, in order to kick off the presentation, I think we can quite agree that illicit financial flows, tax evasion are pressing policy concerns for developing countries. And they have become the subject of increasing multilateral attention. Just to mention, there are two milestones in this regard, which have been recently undertaken. For instance, there is the famous Mbeki report that was sponsored by the African Union and the Economic Commission for Africa by the UN. In 2015, that has actually put IFFs in Africa on the map for the first time, where IFFs were measured through trade-based statistics. And we have recently also an UNCTAD UNODC-led initiative that is currently trying to measure IFFs as part of the measurement of the Sustainable Development Goal Indicator 16.4. Now, the pandemic, and particularly the government's fiscal responses on a global level, have again put the importance of combating IFFs and tax evasion back on the agenda, as combating IFFs and also tax evasion are essential elements for domestic revenue mobilization. And given the strong fiscal responses by governments, an increase in domestic revenue mobilization is more needed than ever. However, the main challenge to IFFs is that these flows, as I said before, are inherently secret and poorly defined. What makes measuring them, analyzing, and quantifying them in the end through targeted policies a veritable challenge. This presentation provides some overview of the recent policy discussion on IFFs, the measurement challenges, as well as the new approach and joint project with South Africa, as I've already said before. So why are IFFs so harmful? They are harmful to countries in multiple ways and independent of their appearance. Tax and customs-related IFFs, for instance, represent substantial amounts of lost and foregone tax revenues, particularly for developing countries. IFFs is money foregone that could have otherwise been spent on the reduction of poverty and inequality, preparing developing countries' economies for structural transformation, for instance, towards a greener economy, or protecting both societies and the economy against global challenges such as climate change. IFFs may further drain reserves, undercut legitimate trade, and jeopardize the business environment, for instance, through corruption. IFFs also undermine the investment base of countries important to fund essential public services or the sustainable development goals. This is simply money or potential investments that are not spent on ad hoc policy measures, on job creation by governments, or the provision of high-quality public services. Apart from the financial aspects, IFFs undermine trust in governments. IFFs may lower tax morale, which results in a further erosion of a sometimes already diminished tax base, and IFFs hamper governments' ability to tackle crime and reduce corruption, particularly as these flows are transferred across borders and prosecution by national authorities is considerably hampered. Combating IFFs, therefore, will not only improve domestic resource mobilization, but will also support and reinforce government social contract with its citizens and a favorable business climate for private sector investment. Next slide, please. Let us start with the difficulty of defining IFFs. As we said before, the categorization of IFFs is a challenging task. There have been many attempts in the past, but unfortunately to date, no commonly agreed definition of IFF exists, resulting in sometimes different and conflicting terms that obscure the nuances of IFFs and of the different subcategories that are needed for targeted policy responses. Only recently, a broader consensus actually started to emerge. Baker in 2005 championed the definition that departed from conflating capital flight, so capital that flows out of a country or escapes a country on the seek for better returns, with IFFs that are simply illicit and illegal outflows of funds. In 2013, UNECA also coined the definition of IFFs as money illegally earned, transferred, or used, which is arguably quite broad, but still adds another dimension to the definition of IFFs. Since then, the nature of IFFs as cross-border flows generated by transactions and contravening national or international laws took hold. The World Bank in 2017 defines IFFs with a focus on cross-border movement of capital that is associated with illegal activity in the local jurisdiction. However, despite all of these definitions and approaches, the term illicit financial flows is still subject to disagreement for statistical purposes, rendering sound measurement a challenge. Now, as we've said before, recently, the 2030 Agenda for the Sustainable Development of the United Nations identifies the reduction of IFFs in its key target 16.4 for the Sustainable Development Goals. It's a reduction of the target, therefore a reduction in cross-border illicit financial flows. In order to create an indicator for measuring progress, UNODC and UNCTAD established a new conceptual framework for the statistical definition and the measurement of IFFs. This is actually depicted on the right-hand side of your screen. This framework offers a typology that is based on IFF generating activities that are either split in illegal activities or also in legal activities. The illegal activities account illegal markets, for instance, trafficking, and smuggling, activities of corruption, such as bribery, embezzlement, theft type and terrorism financing or exploitation types, such as slavery, and the illegal activities of illicit tax and commercial activities. As you see, the element of illicit tax and commercial activities in this UNCTAD framework straddles both sides of legal activities and illegal activities. While illegal tax and commercial activities and practices are clearly defined, the inclusion of tax avoidance is, however, still contested. Proceeds from these activities are considered IFFs when they lead to cross-border flows, or when financial assets are transferred to commit crimes or have their origin in above crimes. Next slide, please. The difference between IFFs and tax avoidance is, as we have said before, still a contested debate. As according to the UNCTAD UNODC framework, IFFs should cover both the legal and illegal tax on commercial IFFs. The illegal component is relatively clearly defined as it refers to illicit practices by legal entities or individuals with the aim to conceal revenues or reduce tax liabilities, outright tax evasion, for instance. The key legal form in this framework, however, thus legal by definition refers to tax avoidance. However, tax avoidance generally involves tax planning undertaken within the letter of the law. There is often substantial legal ambiguity regarding the dividing line between tax avoidance and tax evasion. So the range of tax avoidance could be considered rather as a continuum of activities with fluid boundaries between legal tax planning on the one side and illegal tax evasion on the other extreme, such as proposed by the European Commission. In the context of the SDG indicator and the proposed UNODC UNCTAD framework, tax avoidance, though generally considered legal, has been included as an IFF. However, strictly categorizing tax avoidance or BAPs as IFFs brings up considerable challenges. They may result in insufficient attention being paid to other previously mentioned IFF categories, such as illegal markets or theft and exploitation type activities, or they may result in distorted IFF estimates, for instance, when activities by multinational enterprises result from tax-based changes of individual countries and not necessarily activities by the multinational enterprises themselves. So the distinction between licit and illicit forms of tax avoidance seems impossible to draw and is therefore potentially quite misleading. Let's have a look at the global estimates and the related measurement challenges. So despite the challenges in defining IFFs, several policy actors in the past have tried to quantify them. The resulting amounts are, as you will see, as heterogeneous as the assumed underlying activities that may have generated them. Several estimates are based on aggregated trade data, assume that IFFs are pretty large. For instance, Global Financial Integrity in their most recent report shows that IFFs from developing countries in 2018 alone amount to $1.6 trillion. The Mbeki report from 2015 estimated that IFFs from Africa during the period of 2000 to 2008 amount to around $162 billion. In terms of global scale of individual tax evasion and offshore wealth, recent studies have shown that non-compliant offshore wealth in 2007 have been estimated to amount to as much as $5.6 trillion, and results for individual countries are therefore often derived from these aggregate results. So Global Financial Integrity, for instance, just backs out the estimated amount for South Africa from the global aggregated estimate and report that IFFs, according to these estimates, amount annually to around $21 billion during a period of 2008 to 2019. However, measurement challenges of IFFs arise in particular due to their hidden nature. How can something be measured that is not supposed to be measured? And this makes it hard for conventional strategies, using, for instance, surveys of households, business, or financial institutions to produce reliable estimates. Instead, most commonly, such as the Becker report or also Global Financial Integrity, have relied on approaches that can be defined as top-down. IFFs are measured using errors and asymmetries in aggregated data derived from portfolio or trade statistics, but the exploiting mismatches in bilateral data often conflate statistical measurement errors with IFFs, resulting in inflated numbers. So these differences may, for instance, result from different timing in trade statistics or reporting errors. So estimates based on mirror trade statistics, such as the ones we've mentioned before, are therefore considered unreliable due to challenges in data availability, arbitrary assumptions, or the simple aggregation of categories. For instance, just to give you a couple of examples in this regard, some of these top-down methodologies only focus when mirroring trade data, only focusing on outflows, but neglect inflows, therefore cannot account for reverse IFFs. Sometimes there is also a static difference between imports and exports assumed in order to account for shipping costs. However, a flat percentage of 10% is not at all reliable and is in contrast to what can be considered to be more realistic, where trade costs differ and shipping costs differ for bilateral routes and differ from country to country, based on, for instance, the distance between the different countries or the kind of transportation that has been used. Moreover, sometimes there are also limited samples that only consider certain bilateral relationships between countries of interest, or where methodologies are mixed and can therefore only be hardly reproduced or changed from one year to another. Next slide, please. So this leads us to the conclusion that IFFs, instead of using a top-down approach, so looking at the issue from a height of 10,000 meters, we need to analyze and measure IFFs in a very country-specific context. Why? Different countries may be exposed to different kinds of IFFs. For instance, there are countries with resource-intensive economies that are subject to smuggling activities. We have developing economies that have relatively large financial sectors, where money laundering may be a bigger problem than smuggling. Very open economies generally may suffer more from trade-based IFFs than necessarily from money laundering. So as you see, when talking and when trying to assess and measure IFFs, we need to look at the context of the specific country. So in contrast to top-down strategies, bottom-up approaches, by using granular data from tax returns or tax audits, try to identify different IFF components and produce estimates for each of them. These strategies are better able to account for a country's economic structure and institutional environment, which determine relevant IFF components, their size and institutional capacity to combat them. Developing countries, however, which are very often the main victims of IFFs, may also lack the reporting mechanisms or enforcement capacity to successfully detect and combat IFFs, and therefore a country-specific perspective that concentrates on relevant IFF components, thus allows for a more tailored approach in assessing IFFs and providing the right policy response to combat them. Let's have a look at the exchange of information, which provides us actually the exchange of information mechanisms, the automatic exchange of information, in particular the CRS, under the Common Reporting Standard, which provides us with a new perspective on tax-related IFFs and kind of leads us down the road into not aggregating IFFs, but looking at individual subcomponents of IFFs. And as we're talking about exchange of information, we will focus on tax-related IFFs. O'Reilly et al. In an analysis based on colleagues here at the OECD, we have analyzed the impact of exchange of information on global bank deposits in international financial centers. As you see on the right-hand side, which provides us the evolution of foreign bank deposits in international financial centers, we can see that the deposits in IFCs peaked in Q1 of 2008, just before the global financial crisis, at an amount of $1.7 trillion. Since then, there has been a substantial fall by about $410 billion, or 24%, until the first quarter of 2019. This has not been a linear decline, but strong reductions came in the aftermath of the financial crisis, with a 30% fall between 2008 and 2011. And since then, this decrease has continued by a further 11%. The study shows that the overall decline has been associated by 22% of decline in foreign IFC deposits has been associated with the commencement of automatic exchange of information. Therefore, a significant impact of the commencement of information exchange under the CRS. Tax policy implications become even more relevant with the country's move to a more open capital account and its ongoing process of adherence to the OECD Capital Movements Code. Liberalizing capital accounts can, on the one hand, contribute to growth, but also expose developing countries to the possibility of increased outflows to international financial centers and potentially to IFFs, which is an important concern and focus of work in the adherence processes to the OECD codes. So amid liberalizing their capital accounts, foreign policymakers in developing countries need to address BEPS, but also IFF issues while ensuring sufficient investment for development. At the same time, lighter, more transparent, and less complex capital controls may diminish the risks of circumvention through opaque structures. And for this endeavor, the exchange of information is a crucial tool that, through its reporting standard, can actually strengthen a country's resilience throughout the adherence process and also afterwards to combat and to mitigate tax-related illicit financial flows. Therefore, there is a crucial need for developing countries' policymakers to better understand the relationship between illicit capital flows, tax policies, and the liberalization from capital controls. There is a need for better IFF measure strategies that account for country specificities, as we've seen before. And again, throughout the process of capital liberalization, the country-specific context when assessing IFFs need to be taken again further into consideration. Well, let's have a look at the new insights from a joint OECD and South African National Treasury project, which combines actually the two essential points we've raised before, which is the country-specific focus and the focus on one particular and for South Africa, very important IFF component, which are tax-related IFFs. Please note that the this part of the presentation and also the results we will be showing are very preliminary, as the report is still a work in progress, and therefore only parts of the findings can be shown. Next slide, please. Thank you. Let us start with the context of South Africa and the South African economy. The OECD, together with the National Treasury, have embarked on a joint project that assesses tax compliance, foreign non-compliant wealth, and illicit financial flows. South Africa needs to raise its revenue growth potential and mobilize domestic resources amid high socioeconomic challenges and, in the past, modest growth rates. South Africa has combated the impact of the COVID-19 pandemic severely and comprehensively through comprehensive fiscal measures. However, these measures and the spending pressures have further exacerbated economic and fiscal challenges due to the strong fiscal reaction and also due to the stringent lockdowns on the economy, which have had further impact on economic growth. Moreover, the high spending pressures to combat these socioeconomic challenges also in the future led to a buildup of contingent liabilities and of an unsustainable debt trajectory that needs to be addressed. Comparatively high reliance on income tax highlights also the need for a well-functioning tax administration and revenue collection capacities. So IFFs in this project are defined as flows that are not declared to tax authorities. Again, pretty much quite a narrow focus on one important IFF subcomponent, and individuals engaged in other kinds of illegal activity, for instance, money laundering, are also considered non-tax compliant. Please note that while we're talking about individuals, whenever tax evasion by multinationals has also been reported in foreign financial accounts, this of course is also included in this definition. Next slide, please. Some key questions of the analysis, which we will show you in the findings, and which are addressed in the upcoming report. First of all, what are the key patterns of South African holdings of foreign wealth? So for instance, who holds non-compliant foreign wealth? Where is non-compliant wealth held? What and how much has been non-compliant? And are stocks of foreign wealth consistent with suggested patterns of IFFs in the literature? Do taxpayers respond to the expansion of tax transparency? So how does exchange of information impact tax non-compliance? Who comes forward and when? So again, the disclaimer applies that as the study is still confidential, we can unfortunately only partially disclose some of the findings. Next slide, please. Let's have a look at the data and the methodology applied in this work. We use extensively tax microdata in this analysis, which again is in line, as we said before, in line with a bottom-up approach, which caters better to the needs of a country-specific analysis and which allows for a narrow focus on an IFF subcomponent, which are tax-related IFFs in this regard. So different data sources have been analyzed in this report, which have been thankfully provided by the Revenue Service. We can rely on anonymized individual taxpayer data on foreign capital income, which has been declared, for instance, by income type. We had access to anonymized individual taxpayer data from the Special Voluntary Disclosure Program, data on the Voluntary Disclosure Program, which is still ongoing, And National Treasury also provided us with an analysis of foreign account information that has been exchanged under the CRS, where anonymized individual financial account data from foreign jurisdictions on account balances have been analyzed by National Treasury. Not all of these data sources could have been matched, but at least they were enough to actually gain a comprehensive picture in terms of tax-related IFFs in the country, and particularly how these IFFs can be addressed from a policy perspective. With regard to the methodological approach, well, non-compliance, undeclared foreign wealth, and also related IFFs, have the inherent feature of not being directly observable. Therefore, as we've said before, conventional strategies are seldomly applicable in order to give a relatively precise and reliable picture of what is going on in the IFF space within a country. Therefore, we have relied on indirect measurements, such as descriptive statistics, causal inference, or difference in differences approaches whenever the data allowed. All measures are to some extent assumption-driven, but we were able to back these assumptions reliably up by data. Nonetheless, given the assumptions that were used and that were necessary, results can therefore only provide indications on the degree of non-compliant and tax-related IFFs, and not necessarily a very precise number of how much we are actually talking about. Non-compliant wealth and resulting IFF estimates can be arrived at through different bottom-up approaches. So in our approach, we have largely relied on the CRS data, and we were imputing IFFs from non-compliant foreign wealth with this data. So in this approach, we were taking the stock of foreign wealth in international financial centers that's reported under the CRS. We're assuming a range of non-compliance to estimate the stock of non-compliant wealth. Again, these assumptions have been backed up by data. And we were estimating the amount as a last step of annual flows that would generate that stock based on assuming a fixed rate of return and holding period. Now, this approach is slightly different than what has been usually used in the literature, where the flows have been actually analyzed and a certain share of these flows to be assumed non-compliant. We have actually first started of looking at the stock of foreign wealth abroad based on the foreign account data, have assessed how much of this stock is non-compliant, and then backed out the resulting flows that would have been needed in order to create that non-compliant wealth abroad. So this somewhat reverse or inverse approach gives us the opportunity of being a bit more agnostic about the flows. Moreover, a second approach we have also undertaken as some kind of robustness check was that we were capitalizing foreign income from new tax returns around the implementation of tax transparency initiatives to estimate the stock of non-compliant foreign wealth. So the different income flows from capital income were actually summed up and were then multiplied by an assumed rate of return according to the literature on a global basis and a certain holding period. Next slide, please. Thank you. Let's have a look at the findings, particularly with regard to patterns of cross-border non-compliance. Where and how did non-compliant taxpayers evade? So the Special Voluntary Disclosure Program, which was focusing particularly on offshore wealth, and the Voluntary Disclosure Program in South Africa provide important granular information, but only part of the picture, as only a certain number of people came forward under this program. Tax non-compliance is shown to have a relatively long history, concentrated among high-income earners. And while many taxpayers declared a short period of tax evasion, taxpayers with large amounts of non-compliant wealth tended to remain non-compliant for longer. Most non-compliant taxpayers kept their foreign assets in international financial centers, and non-compliant taxpayers invested predominantly in foreign trusts, stocks, bonds, or bank deposits. Most of these investment trusts were formed and also managed in IFC jurisdictions. Next slide, please. Foreign financial account data under the CRS offers new potential insights on undeclared foreign wealth in IFFs, particularly in contrast to existing sources, such as, for instance, bank deposit data from Bank for International Settlements. CRS data can provide tax authorities with substantial additional information above and beyond these other sources, as they are specifically addressing tax aspects in the global financial system. CRS allows for a deeper analysis of non-compliant foreign wealth, as it also provides information on account ownership or geographical coverage. For instance, a large share of accounts has been domiciled in IFCs, reporting large amounts of foreign assets, as our report will show. Many, but not all, CRS accounts can be matched with tax return data, as some jurisdictions do not provide sufficient information according to the CRS standard. This is particularly related to older accounts that already existed prior to the introduction of the CRS in the respective country. Next slide, please. Let's have a look at taxpayer behavior amid increasing tax transparency. So basically, how do taxpayers react to the implementation of automatic exchange of information? Taxpayers react to the commitment and to the commencement of automatic exchange of information by disclosing more often and larger amounts of foreign capital income. The implementation of automatic exchange of information seems to have driven applications by individuals to both voluntary disclosure programs, and applications by individuals to the voluntary disclosure and the special voluntary disclosure program spiked just before the commencement of the automatic exchange, and therefore this provides us with a clear signal that the commencement of automatic exchange of information has also triggered an increased responsiveness by taxpayers to domestic tax transparency initiatives. There has been a general increase in new tax filings. So new tax filings with regard to previously unknown taxpayers to the Revenue Service, and disclosed amounts of foreign capital income around the announcement and the commencement of exchange of information. For instance, there is an increase in new tax filings with regard to foreign interest and dividend income around 2014, so around the announcement of adhering to the automatic exchange of information, and there was another increase in new tax filings of foreign capital gains and foreign dividends in 2017, when the exchange under the CRS actually started. The amounts of foreign capital income declared by new filers also peaked in 2017, where top income receivers declared by far the largest amounts. Apart from the AEOI, the difference in tax transparency standards between between the exchange of information on request and the automatic exchange of information also seems to have induced different behavior by old and new filers, where while the earlier responses were actually triggered by the exchange of information on request, as more information was needed and required in order to file such a request, the reaction in 2017 was actually the result of predominantly the automatic exchange of information due to the automatic exchange between partner jurisdictions. So overall, the evidence suggests that enforcement initiatives may have substantially increased taxpayer compliance and may also continue to do so in the future. So let me conclude. IFFs, as we have seen, are notoriously difficult to define, to identify, and to measure. Measures that are based on aggregated data, such as trade data, investment data, so the generally known macroeconomic statistics, may therefore lead to conflated and also inflated IFF estimates. On the other hand, approaches that are based on granular data, such as the CRS or tax audit or tax return data, are also often assumption-driven and can only approximate the true size of IFFs. But given the granularity and the narrow focus on specific IFF subcomponents, they are more precise and they are able to assess the consistency of existing aggregated estimates, as we have seen before. So as the joint project with South African authorities has shown, IFFs need to be considered in a country-specific context and need to be analyzed and measured accordingly. Therefore, close collaboration between the OECD and the respective program country is needed in order to understand a country-specific context, in order to focus on one or several specific IFF subcomponents that are relevant for the specific country and that can be addressed accordingly with tailor-made policy responses by national governments. Successfully combating IFFs, therefore, on a national level, requires the development of analytical skills in national authorities and also enhanced interagency collaboration on an international level. Thank you very much for your attention, and I think we can now address some of the questions that were already raised in the chat box. So let me check. Judge overcome. All right, I'm just opening this up. So the first question that came in by Isa Tussar to everyone: how can a strong international system architecture that is ready to combat and fully eliminate the problem of IFFs be achieved given the variations in country-specific economic and financial laws? Well, obviously, I think we've said that before. IFFs are to a very large extent a country-specific issue, depending on the economic structure and also on the institutional setting of the specific country. So yes, although IFFs are cross-border, they are also violating national laws, and therefore it requires more of a systemic approach on a global level, based on two pillars. One is the national pillar, where where national laws and the national context in fighting IFFs need to be considered. The second pillar is the global context, as you have alluded to, where, for instance, global mechanisms such as exchange of information, for instance, global initiatives that we also have at the OECD are an important tool to generally mitigate IFFs on a global level, and to increase transparency, particularly tax transparency, when it comes to moving funds and moving capital abroad. A second question: illicit financial flows and the tax avoidance related to financial flows can have significant impact on economic stability of a country and the broader global financial system. How can this challenge be overcome, since it can also affect the law-abiding citizens? Well, yes, indeed. I think this question is a bit related to the first one. Well, this is a veritable challenge for developing countries, no doubt. But on the other hand, well, for the broader global financial system, needs to be fit to cater towards the needs of global citizens. Again, this is the one pillar where the international system needs to be fit in order to, through a more systemic view. And the other pillar, the first pillar, which in this regard is, I think, even more important, is the national system. As the national system, national laws eventually determine to some extent what is or what can be done in terms of combating, mitigating IFFs, what is reported through domestic banks, where funds are, for instance, channeled abroad, whether there is money laundering going on. So the national system definitely plays an important role, and the country context as well. As we've said before, money laundering and also smuggling of certain raw materials are two different sides of the same IFF coin, but they need to be addressed differently. And if you are a law-abiding citizen, then, well, obviously you should not have anything to fear, as you're not conducting any illegal activities that go against the law. Another question: trade-based money laundering is a major component of IFF as well, and is documented by multilateral bodies like FATF. Yes, absolutely. Thanks a lot. Yeah, FATF definitely in this regard plays an important role, and money laundering is definitely an important component of IFFs. There were more again by ISA 2. Amidst the ongoing, this is related to the COVID-19 crisis. Amidst the ongoing COVID-19 crisis, it's more important than ever to invest and foster societies that are resilient to threats of tomorrow. How can stronger measures against transnational organized crime and the implementation of more effective criminal justice systems and capabilities be achieved, especially in resource-limited settings where corruption is normal practice? Well, yes, this is definitely an issue, and this is nothing that can be changed from one day to another. Again, I think as we have also said in the presentation, the capabilities of and the capacity development in domestic national authorities is an important area in this regard, in terms of detecting it, but yeah, also enforcing the laws which in which corruption is also considered to be an illegal practice. Corruption as a normal practice, well, it might be acceptable in a societal concept, but it is not legal. It is not legal in a legal perspective. Therefore, it needs to be assessed and it needs to be enforced. And this is the area where national authorities, that they need to increase their capacity in order to detect, but also to enforce it together with national police forces. Yeah, I see that Piers has already responded. In the South African context, a question by Erickson Hatuswa. I hope I pronounced your name correctly. In the South Africa context, what is the main goal of combating IFFs? In the South African context, the main goal of combating IFFs is increasing domestic resource mobilization, increasing the tax revenue potential, particularly as we've seen, or as the COVID-19 pandemic has shown, and which is not only an issue for South Africa. I think this even goes beyond the context of developing countries, as many countries have actually reacted forcefully to the pandemic. That fiscal measures and further funding are needed for improving the quality of public services, for instance, for mitigating the impact of climate change, for preparing societies and preparing the economy, particularly in developing countries, for the future and for global challenges that are ahead, such as structural transformation. And therefore, combating IFFs is an important element in domestic resource mobilization. And it therefore needs to be targeted with a tailor-made process in a country-specific context. Are there any more questions? I don't see any. No, I think this seems good. Well, if there aren't any further comments, I would like to thank you again for your attention and for your patience. And I hope there was a hand. Okay, there was a hand raised by a participant, but it was lowered again. No, I don't see any. I don't see any raised hand anymore. Okay. Well, then I think, yes, as we are on time, I think it's about time to close the session. Thank you very much again. And I hope you stay on for the next session as well. That is following in this one. And have a nice afternoon or a nice evening. Thank you very much. And yes, of course, should still questions arise with regard to the presentation or to the main messages, you are, of course, more than welcome to send them to us by email, and we will reply within a relatively short time frame. Thank you very much. And yeah, have a good day.